Good morning, professionals, and welcome to another class. Remember that last week you actually stopped at cash flow statement, where we actually examine the various ways of, we actually examine the various methods that is available for statement of cash flow IAS 7. But when they ask you what is statement of cash flow IAS 7, I told you in the simplest term, statement of cash flow known as IAS 7 is just a statement about the inflow and outflow of cash and cash equivalent. What do we call inflow? What comes in? What do we call outflow? What goes out? That's just what you need to know. Inflow and outflow of cash and cash equivalent. When we say cash, item IAS 7, known as statement of cash flow, is actually for your transactions that involved immediate payment of cash. Do you hear that? It involves your transaction. When we say transaction, buy, sell, and any movement. Cash and cash equivalent, that's what I call it. When we say cash and cash equivalent, it means the transaction that actually involve cash alone. If you transact on debt, that one is not a cash flow items. Let's assume that somebody buy items from you, or you also bought items from person on credit by promising to pay the person in a future date. That is not a cash flow items. And as a result of that, do not treat that as a cash flow items. Okay? So when we say inflow of cash, we actually mean what comes in. Outflow of cash, what goes out. If you really understand that, then you are already 70% okay in statement of cash flow. And let me tell you, no matter what you see in the question, if you are able to understand what you want to do, my dear, you are fine. Statement of cash flow statement. Statement of cash flow IAS 7 is one of the bonus, question that I can do set. Obviously, ICA might set cash flow statement, ICA might not. Okay, but when you see statement of cash flow, my dear, grab your copy, because it is one of the bonus questions you could ever get in ICANN examination. How do you grab your copies? You have two methods of statement of cash flow, either direct or indirect. Is that not? Most of us tend to run for direct method because it involves the preparation of ledger. You remember when you are in your school, most especially during our first and second year, when we are doing principle of accounting. Remember, from cash book, from sales day book, they ask you to take it to cash book. From that cash book, they now ask you to prepare ledger. Preparation of ledger is when you want to determine the customer that is owing and the one that has fully settled is B. In order to know that, you have to open a customer's ledger. Let me use my this so that you can get it right. If you want to open a customer ledger, let's take for instance, I want to open customer ledger. Okay. This is the customer ledger. You call it customer account. Remember, and your ledger is like this. Initially, customers, what did they do with? Sales. They are those people that you sold your items to, that will call your what? Your customer. This is a sales account. Is that not? Customer is an individual account. All sales must be what? Credited. So you credit sales. You credit sales in the sales is credited in the cash book. In the ledger, it will be debited. Let's take, for instance, you first of all have your what? Balance brought forward. This is just a basic accounting. You have your balance brought forward. Then those people that you sold items to, let's assume you sold to Tade, you sold to Shola, and under the customer account, let's say this account is Shola, because it is an individual account. This one is debited. This one is giving out the money, so it must be credited. Let's say sales. And remember, at the end of the day, you'll be having your balance carried down here. This balance carried down that you're having here is just for you to use it to balance up your account, which will now balance it here, which will also be what? Balance brought down here. And it is this balance brought down that you actually needed. The same thing you do in statement of cash flow. When you're given a statement of cash flow, you will have to prepare your customer's account in order to really know who are owing and who are not owing. But how will you know that? Customer's account, let's come to professional level now. Let's come to ICANN level because we are professional. That's why I said let's come to professional level. So all customers are whom we call receivables. If you are working and if you are a student, you have been hearing receivables. Do we get it? We have receivables and payables. When we say receivables, receivables are what we call all these people that are owing us is what we call receivables. Is that taken? So for receivables, you will just list all those items that are owing you. Receivables must be debited. Is that taken? You just list them. If you list, let's assume that you have your balance brought down. You have your balance brought down here. Let's assume that Shola, Tade, and Co. bought an item from us. So that is how you'll be having Shola 200, for instance. Let's say balance BD is 10 naira. Shola is 200. Then Ola is 50 naira. Funke is 20 naira. Ifeoma is 100 naira. At the end of the day, you need to balance up your account. The balances that you are having as the balance BD, in order to gross up this amount, let's assume that you have, it says here, just let's say this one is what? 370. This is 370. This is, let's say this one is 100 naira already, 370. Let's say I have 400. You know, the total of this is 500. In order to have 500 naira here, in order to have 500, you first of all have to gross you will have to balance this one up as balance carried down. And the balance carried down, 500 minus 370, or what did you calculate here? 300, 370. 370 minus 500. The remaining balance is what we use to gross up this. And that 130 that you used to balance it up as 500, you now take it here as balance BD for the next year or for next period, which is 130. This 130 means the customers that are what owing us. Is that taken? That is what we need to do under statement of cash flow when it comes to a direct method. So you don't have to put yourself under unnecessary duress, under unnecessary stress. When it is a statement of cash flow, it's either you use direct method or indirect method. Now, I can hear somebody asking me, what if they ask me for direct method? And me, I like indirect method. What will I do? It is easier. The question tells us that kindly prepare statement of cash flow. Let's assume this question. Prepare statement of cash flow for SMAN PLC in accordance with IS 7 using direct method. And I want to use indirect method. This is the clue, int, expo that you did not pay for. Yes, giving it for you as a bonus. The question says using direct method, right? And me, I don't like direct method. And I want that question as a bonus question. My dear, just state it that using direct method. Then have your P, deep, IRP, IT. Just say profit before tax. You still remember that our formula? Oh my God, I love calling it formula. Though it is a mnemonic. When we say mnemonic, it means an abbreviation, something we just coin to become SWON. Okay, this P is profit before tax. In every question, you see your profit before tax. After profit before tax, what are those things that is in our statement of financial positions that does not involve movement of cash? That is what we call non-cash items. Why is all these non-cash items? All this thing does not involve cash, and we have already used it to decrease our profit. What do you mean by decreasing our profit? All these items that we do not give out money for, or we do not receive money on them, we now use it to lessen our profit, to reduce our profit. Add them back, because we have to know the true face of the items we collected cash for. That is what we call it. That's why we call it add back non-cash items. What are the first one? The first one is this D, means depreciation. Depreciation. The I means impairment. You will know that impairment does not involve the movement of cash. The P there is provision. Okay. The I, the second I, the F is a finance cost. So let's assume this is just what I have. Okay. If you now add back all these non-cash items, if you add them, you will now have what we called, after adding the non-cash items, then the next one you have is cash flow from ordinary activities. Then you now go to look at your asset. Is there any increment in your what? In your operating activities? That is what we call this dash that you are seeing, that I put here. This dash that I put in that mnemonic or in that formula is to tell you the next line of items. Okay, so you now go to the IR, which is inventory. That inventory can be increase or decrease. Note that if you have increase, what will you do? If you have decrease, what will you do? Let's look at it. This is a practical formula. Your inventory is your items that is available for sales or that you are selling. It's your goods, your items that are selling. That's what we call inventory. In a normal sense, stock. You all know what we call stock now. If your inventory increases, if your stock, your goods that you are selling in your shop, if it increases, what does it mean? It means you have used your money to buy raw material to have produced that goods. That is why your goods increases. So any increase in inventory is a what? Reduction in cash. Do we get that? Increase in inventories means reduction in cash. Remember that I told you that all what you are doing is what involves cash and cash equivalents. When I say cash, that's your money that you collected, raw money that they give to you. If I say cash equivalent, every other forms of cash or every other forms of money that is like a cash, such as what? Check, bill. Are you getting it? If I give you a check, you can't say I'm not giving you a physical cash. If I give you draft, you can't say I'm not giving you a physical cash. If I give you bill, you can't say I'm not giving you a physical cash. The bill is not to settle debt too. As in, if I say pay off my bill, no, that's not the bill. It means a bill of exchange. That's what I'm saying here. Bill of exchange is just the forms of transactions which guides the seller against the loss of his what? Money. So it is used in place of a physical cash. Let's go back. When your stock increases, It means you have paid out money to buy that stock. That's what it means, which means your cash goes out. And if your cash goes out, it will what? It will reduce. So if it is decreased, you will reduce it. If it is increased, you will add it. I mean, if it is increased, you will less it. If it is decreased, you will add it. Okay? Let's see. This is what I'm saying. I said increase in inventory means reduction in cash, which means cash outflow because money goes out. Cash outflows, money goes out. But if your stock, that's your inventory, if it reduces, let's assume at the beginning of the year, you open your shop with a stock of 100. And before the close of business, that stock remained 20. What happened? My professionals, you have said those items now. Those items has been sold. It means when you sell an item, what happens? Money comes in. You have money. Is that not? So any decrease in cash, decrease in cash, decrease in cash means what? Increase, I mean, decrease in inventory, sorry. Decrease in inventories, means what? Means increase in cash. That is cash inflow. Cash inflows. I hope you are together. That is how to do inventory. After I, what remains? It remains R, IRP. That's what I call it for you. Then the R is what? Receivables. Receivables means customers that are owing you. How do we treat receivables? Receivables can also be increase or what? Decrease. My dear professionals, if your receivables increase, what happens? Increase in receivables means more people are owing you. Your money is outside. People are not paying you. So increase in receivables means what? Outflows, the same thing. Increase in receivables means what? Means reduction in cash because money is not coming in now. It means reduction in cash. So that is what? Outflow. People are owing your money. They are disturbing your business. They are not giving you money to do more business. It's bad now. Okay? But if there is a decrease in receivables, decrease in receivables means what? Means increase in cash. That is, when your customers are paying you, what happens, my dear? It means your what? It means your cash is increasing because you now have more money to do business. More money you have received. More money is coming in. More money you have to do business without having to be worried any longer. Okay? So, having done that, the P there is a what? Is payable. The P is what? Payables. Yeah, let's look at payables. At times, they can give, okay, payable. So let's talk payable, increase or decrease. How do we do that? If you have payables, payables are your suppliers, people you are owing. That is your payables. For your payables, if payable increases, what means? Increase in payable means you have given more money outside. Okay? Increase in payables means reduction in increase in payables means when your payable increases, it means you are not giving out money. So increase in payable means increase in cash. Means increase in what? In cash. That is what? Inflow. You are just buying all those items in BC, in debt. You are not paying them. So you will have more money inside to do business. But any decrease in payables means what? Reduction in cash. That is what? An outflow. Okay? That is an outflow. So it is after doing this IRP, you now get cash generated from operating activities. You now less interest paid, tax paid, interest paid, tax paid, interest paid, tax paid. Don't forget, the P is for profits before tax, D is for depreciation, I is for impairment, the P is for provisions, the second D is disposal of NCA, disposal. Let me write it here for you so that I won't clog the distance. I have P, diff, IRP, IT. The first P is profit before tax, as explained. Profit before tax. Then add your non-cash items. Non-cash items. What are your non-cash items? Adjust for them. That's why this dash means there's something there which is non-cash items. So the first P is depreciation. The I is impairment loss, if there's any impairment loss. The P is provisions. P is provisions. The second I, this is deep. The second D is disposal of non-current assets. If there's any disposal of non-current assets, you must have 2 naira. If there's disposal of non-current assets, then the second I is if you're given any investment income. If they are given any investment income, and the F is what? Finance costs. If you add all these things, if you add it back to this, you'll be having, that is your cash from what? Adjustment for non-cash item. You are through with this. This line means the next one is cash generated before changes in cash flow. Just say cash generated before changes in, you can say before changes in working capital, WC. What is your working capital? Your working capital is, this thing that you get is cash generated before changes in working capital. Now, changes in working capital. What is your changes in working capital? Your changes in working capital. Your working capital is IRP. Is that taken? That is your working capital. Your working capital is your what? The first I is inventories. R is receivables. And at times, you might be given prepayment. That is, if a customer pay in advance, treat it as that of what? Receivables. But you just have to note which one is outflow, which one is inflow. If customer pay you in advance, that is prepayment. The customer pay more than what is required. Any advance payment, your cash will what? Increases. Is that taken? Then IRP, the P is what? P there is payables or accruals. Accruals, at times they might give you accruals. If it is accruals, it means customers are owing you. Your cash will reduce. It means cash outflow. Is that taken? If you add all these things together, you will bring it here. It's either you add or you less. Remember, do not forget. It's either you add or you less. It's either you add or you less. As the case may be, bring it here. You will get cash flow from operating activities. This will give you cash flow from operating activities. You don't have to cram all these things. Practice question. Follow my method. This one means non-cash items. This one means after you've done all these non-cash items, you will get cash generated before changes in working capital. Then the changes in working capital is IRP. You will get cash flow from operating activities. Then you do your IT. What is your IT that you want to do? Your IT is interest paid, tax paid. This tax paid, you will always adjust because it will be given opening balance. So it will be opening plus charges for the year minus closing. But in order to get the charges for the year, you have to get closing less your charge for the year, then you get the distance. That is how tax paid. But your interest paid, this your interest paid is the same thing as what? Finance costs. The figure you will use here is also what we use here. Please do not forget. It's also the same thing. Tax paid, you will have to adjust for your tax. Whatever you get here, bring it here, then add everything together. You are just being through with operating activities, and this will give you net cash flow from operating activities. And after you've gotten that from operating activities, so after you've gotten that, just quickly go and do what we called, what do we call it? Just quickly go and do investing activities and financing activities. And with that, my dear, you are fine. Is that taken? So let's quickly hit the bull on the head. Since we've gotten this hypnosis, let's go to the basic calculation. All right. Okay. So apology for that. Yes. So to prepare statement of cash flow, the minimum information you need, as I said, to prepare statement of cash flow, which minimum information do I need? Ask yourself. You must be given current year profit or loss. This is current year P or L. Then they will give you 2 years statement of financial position. Then you will have your additional information. These three will always be present for you to solve statement of cash flow, IAS 7. Then ask yourself, which information do I need in additional information? My dear, why you are checking additional information is for the information relating to the what? Non-cash items. I've already explained non-cash items for us, such as depreciation, amortization, and goodwill impaired or written off. You say impairment loss. That is on goodwill. Goodwill written off is also impairment loss. Then information on what disposal of assets and investment. That's why you see disposal of non-current assets. Non-current assets can be physical assets or investment assets. Then dividend and interest received. Then you have your dividend paid, hopefully. So if you have any of this, that is the reason why you need your, what is it called? That is the reason, that is the information that must be available under your additional information. And that is what you needed there. So in solving cash flow statement, including group cash flow, using indirect method, I've already told us what we needed. So I don't need much explanation. But when you are solving for the direct method, just use cash received from customer. You calculate for that. Your cash paid to supplier must be deducted because it is cash outflow. Cash received from customer is cash inflow. Operating expenses is an outflow. Then you have your tax paid, also an outflow. All these are what you are going to prepare ledger for, or what you call working notes. Is that taken? Check the previous class, you will get that there. Then at the end of the day, you will get net cash flow from operating activities. But how do you get your cash received from customers? Trade receivables at the beginning. That's what you call receivables. Trade receivables, what do we call it in all this thing? I don't even remember again. But you all know trade receivables. So that is trade receivables at the beginning. Then you will add your revenue in the P&L figure. This is how to go about it. Add your revenue in P&L figure. Then you will less your trade receivable at close, at end. What you will get is cash received from customers. I hope that is cleared. If they ask you to prepare direct method, it's as simple as that. Opening trade receivables, add revenue in the P&L, less closing receivables. Then you will arrive at your cash received from customers. It's a, why are you adjusting? It's for you to get the total cash that customer received, that you received from your customer. But if it is payment to supplier, that will be what? Trade payable at the beginning. You are already given. Then add your purchases in the P&L account. Purchases in the profit and loss account. So you add purchases in P&L account. That is the figure. The figure you are given in the P&L for purchases, you will add it. And you less your trade payable at the end. Then what we have is what we call cash payment to what? Suppliers. Is that noted? Let's proceed. I said, but remember, you will not see purchases in the financial statement, but we have to derive it using what? Using your opening stock, add purchases, less your closing stock. Okay, remember that our cost of sales, if you want to calculate your cost of sales, let's take for instance, if you are preparing your, what is it called? If you are preparing your account, you have opening stock. You have opening stock, Abi, like this. Add what? Add purchases. That is if you are preparing your P&L account. Opening stock, add purchases, add carried inward, less returns outward. Add purchases, you have this. Then less what? Closing stock. Less what? Closing stock. If you less closing stock, you will now have your what? Opening stock, add purchases, add carried inward, less returns outward, less closing stock. If you less closing stock. From this, we have cost of goods sold. Abi, what we have is what we call cost of sales. So if you want to work back, you will now have this cost of sales. Cost of sales, what you less, you will add it back. Add your what? Closing stock. Then you add purchases before, Abi. Remember that it's opening stock, add purchases. You will now less opening stock. Then your result will now give you what? Purchases. That is how to determine purchases. Cost of goods sold, known as cost of sales, add closing stock, less opening stock. It will give you your what? Purchases. Because in your statement of in your P&L account, you will be given cost of sales. That will be what? Revenue. This is how your P&L will be. Revenue, cost of sales. If you less cost of sales from revenue, you arrive at your what? Gross profit. Don't forget, you now have expenses. So if you less expenses from gross profit, you will have what you call profit before tax, like that, like that. So this cost of sales will be given. It is the cost of sales that will now add to your closing stock, given to you in your additional information. Then less your opening stock, given to you in your additional information or in your SOFP. In your SOFP, you'll be given 2 years. Let's say 2019 and 2020. Any figure you have in 2019 is an opening figure to 2020. Anything you have in 2020 is the closing figure. That is, so if you have inventory now, let's take for instance, if you have inventory in 2019 is 10 naira and in 2020 is 5 naira. It means opening inventory is 10, closing inventory is 5. So if you want to calculate your purchases, you will have cost of sales that were given in the statement of financial position. Let's say 20. So you have 20 plus closing stock, which is closing inventory. Closing inventory is 5 minus opening inventory, which is 10. Then your purchases will be 20 plus 5 minus 10, which is what? 15. That's how to determine purchases. I hope that is cleared. Another item is operating expense. To calculate your operating expenses, you will have all operating costs, known as what? Distribution costs, admin costs, depreciation, amortization. You will now add profit on disposal of PPE and less loss on disposal of PPE. I hope that is clear. If the answer is yes, then the same thing applies to investment. For investment, you will add accrued expenses at the beginning, then you less accrued expenses at close. Then add any prepaid, less any prepaid. All right, let's practice. Kenko. Oh, let this one be my question. I don't even know the question we stopped. That's I didn't put that. We are given the Kenko statement of Kenko statement of profit or loss for the year ended 31st of December 2002, and statement of financial position as at the 31st of December 2001 and as at 31st of December 2002. Okay. Now, look at the statement of profit or loss. You have your sales, you have raw material consumed, you have staff costs, you have depreciation, you have loss on disposal. Is that taken? Then we also have other items. as given. Look at your statement of financial position. You have 2002, you have 2001. 2001 is opening. As I told you, and 2002 is what? Closing. Any figure you have there is closing. Is that taken? So let's take note of that. All right. Do we have any additional information? Then let's go. You have your non-current liability, and you have our total equity and liability. Okay. So prepare statement of cash flow for Kenco for the year ended 31st of December 2002 in accordance with the requirement of IAS 7 using the word indirect method. Last week, we actually looked at direct method. Today, let's look at indirect method. Okay. So to look at indirect method, I gave you some hints. I said first, begin with the cash flow from operating activities. I've already given you that. That is when I said you should actually look at, you should calculate using PDIV. The formula given to you, you can say PDIV use PDIV IRPIT. Okay. That's it. All right. All right. So it's either you use PDIV, IRPIT. And if you like, you can use PDIV, IRPIT. It depends on you. Yes, the two are still the same. I will show you why it is the same. Okay. So for the PIF, it means you are putting investment income and finance income, you are making it to come first. Instead of this, you can also use PIF. Then you have DIP, but here you have to use two DIP. PIF, DIP, IRP, IT. You see, it's still the same thing. Profit before tax, investment income, finance cost. Then you add non-cash item, depreciation, disposal of non-cash, disposal of non-current assets, then impairment loss provision. Then you will get cash flow before changes in working capital. What are your changes in working capital? Inventories, receivables, payables. You can have accruals and prepayments. Then you have cash flow from operating activities. Less your interest charge and tax paid. Interest paid, tax paid. That's it. And do not forget that your interest paid is the same thing as your what? Finance cost. The amount you use there is also what you use there. Calculate the cash flow figures for purchases or sales of non-cash assets. I've already given you all these things. So the hint that is available here for you is just for you to still go through it. Okay. All right. Can we now solve? You've seen the question, so let's solve. You have seen the question, let's solve. What's the first thing? Locate your profit before tax. If you look at your account, we see that you have interest payable After interest payable follows profit before tax. Then you have profit for the year. Nothing concerns me with profit for the year. Nothing concerns you with taxation. You will adjust for that. Nothing concerns you with profit for the year. Use profit before tax, PBT. Is that taken? So go to your PBT, pick your PBT first. What I did there were just an adjustment. Okay, but let's take it one after the other. Cash flow from operating activities. If you are actually working in examination, how do you open everything? What you want to work with is Kenko, right? It is Kenko. Let's say Kenko. Just say Kenko. Statement of cash flows. Your statement of cash flow, let it take the first heading. Then you will now put for the year ended or as at, but always look at what the examiner states. If they say prepare statement of cash flow as at, then you use as at. If it is prepare statement of cash flow for the year ended, you to use for the year ended. This is what I'm saying. Go back to the question. Prepare statement of cash flow for Kenko for the year ended. Can you see it? If they say for the year ended, use for the year ended. If they give you ASAT, use ASAT. So for the year ended 31st December 20x2, underline. That's what the question says. Then put your two, is it naira or dollar, in thousand, in thousands. Then you have your what? At the back of your answer booklet that you'll be using for rough sheet, that is where you will put this PIF dip IRP IT. Okay, so the first one is what you are first doing is operating activities. Write it in capital letter. I'm telling you this, I won't be telling you this going further. Operating activities. Then profit before tax, that is the first P. You can write down your items so that we just be putting it. Profit before tax. Then the first one is profit before tax. After profit before tax, just leave the distinct. Then you have investment. Okay. Then you have your what? Finance cost. Finance cost. So after having your finance cost, then after having your finance cost, just write it like this. Then you can put a line, or don't put the line. Don't put the line. Just leave it like that. Leave a line and write adjustment for non-cash items. Or you just write adjustment for NCA. Anyone is allowed. Okay. Adjustment for non-cash item. The first P is disposal of NCA is allowed. The second one is what? Depreciation. Anyone you like, you can bring first. Depreciation. What's the next one? Impairment loss. After the impairment loss, what's the next one? you have provisions. You have provisions. You've opened it down. After provisions, leave one line. Just write operating activities. And if you like, don't write it. Operating activities before changes in working capital. Then you got ensure that you write changes in working capital. That is your IRP that remain. Then you have inventories. You don't need to be writing increase or decrease. Okay. Just write your inventories. After your inventories, you write your what? Receivables. Then you have your what? Payables. And after this, note that you'll be having after you write receivables and payables, because you do not know what will be in the distinct. This is investment income. I didn't remember how to put it. Because you do not know if you might be having accruals and prepayment. And if you like, you can even put accruals, prepayment. But you can actually leave a line for that. Then after that, you will have operating activities. Operating activities cash flow or cash flows from operating activities. Then you have your interest paid, tax paid. This is your first page. Then you now go to your, you know that you've opened everything down now. This is open. You've opened everything down. Just as you've opened it down, the next thing for you is now to be inserting those figures. Okay? So you now go to your next page. Okay, after interest paid, tax paid, you have your net cash flow from operating activities. If you like, you can close it. If you like, you can leave it unclosed. Anyhow you want it. This will now be net. Oh, don't put dash. This will be net cash flow from operating activities. This is your first page. Your operating activities alone can take your first page. Then you use your second page and the third page for what? Use your second page and third page for investing activities and financing activities. Just say investing activities. This one, you don't need to open it down. Investing activities. And if you want to open it down, it is for you. But you don't need to open it down. Just ensure you open down this. Then go to the next one and go to your what? Your working notes. So if there's any workings, you will know. If there's no workings, don't worry. So first of all, pick your profit before tax from your question and put under PBT. Where is it? So profit before tax is what? 392. Just put it, gram, put it there. That's a profit before tax. Put it there straight. Profit before tax, 392. Just put it here. Check. Do I have any investment income? Do I have any investment income? Check your question, whether you have investment income or not. Okay. So let's go to the solution so that we won't waste much of our time because we have a lot to do. All right. But basically, that's how to do it. Profit before tax, 392. Adjustment for non-cash item, depreciation, 115. Loss on sales of tangible assets, 118. Interest expense, 28. Is that taken? All this can be gotten from all these things can be gotten from the question without doing any additional information. Okay? Shall we do it together? All right, if you get it, just type yes. If you get what I'm saying, just type yes. And if not, let's do it together. Our profit before tax has already been given 392. Have you seen it? That is 392. Investment income was not given. Don't bother yourself. Finance cost. The finance cost is also your interest expenses. So finance cost is the same thing as interest expense. That is the interest you are paying on your what? On your investment. That's why we call it finance cost. Finance cost is the same thing as your interest expense, in case you are given interest expense. Go to the question. We have interest payable. You can see it. The interest to paid. And you see that it is under operating profit. Or what is under operating profit, you add them. Or what is above this profit after tax. From this profit after tax up to this thing, this profit after tax, this one was less before, you will add it back. Okay, that is the logic. Remember that this depreciation too, this depreciation, loss on disposal, they were deducted, you will add them back. That's logic. Okay, so no investment income, but I have interest expenses of what? 28. You put it here. You've already opened it. So just be putting it. That is what is left for you. Depreciation. It's like I was given depreciation. You don't calculate anything much. Depreciation, 118. Just go, put it. Depreciation, 118. You already have the solution, you know. I'm just showing you this so that we could understand how we insert. So that you know that you don't have to bother yourself unnecessarily. Okay. Depreciation, 118. Just put it there. Then disposal of non-current assets. Did I have any disposal? I didn't see that. Impairment loss. Let's check whether there's any impairment loss or disposal. Go to additional information. I told us while I was showing you that is where you will get it. Additional information, dividend paid were what? 66,000. During the year, the company paid 90,000 naira for a new piece of machinery. The company paid 90,000 for a new piece of machinery. They've not called us. Let's go to the account. Let's check if we have any loss on disposal of non-current assets. You can see sales, raw material, staff cost, depreciation, then loss on disposal of non-current assets. We have what? 18. Just put it there. Impairment loss. That's our loss on disposal, 18. Then check, is there any provisions? If you didn't see provision, leave it. You don't have to bother yourself. You are not given investment income. You are not given disposal of non-current assets. You are not given provisions. Go to your changes in working capital. I've not done a full destiny. You see that is what I opened that I'm actually putting. So adjust for your inventory. Go and check your inventory. You can adjust here. You don't have to prepare another working note. And you can prepare it in the working note as well. Depend on you. Okay? So go and look at your inventories. What happens? Inventory. At the beginning is what? 24. At close is what? 20. Something might have happened. Is that taking? So at the beginning is 24 inventory. You just have beginning minus closing. What do you have? That is what? 4. That 4, is it an inflow or outflow? At the beginning is 20. Sorry, at the beginning is 20. At close is what? 24, which means your inventory has what? Increased. Is that taking? You just say inventory closing is 24, or you can do it with opening. Opening is 24, opening is 20, closing is 24. What has happened? Minus 4. Because your inventory has increased. The same thing for receivables. Go to your statement of financial position. Your trade receivables at the beginning is 58. At close, it is what? 16. What is the difference? It means it has increased. Okay. So 76 minus 58 is an increment of what? 18 naira. Because it is increased, it is what? Outflow. Look at your bank. Don't look at Benko. At the end of the day, your cash and cash equivalent must give you what you have in the cash or bank. Is that taking? What you have in this bank is what you must have at opening, and this is what you must have at close. It must correspond. That's how to check if I can't get the balance or not. All right, we are still opening everything. For your receivables, as we've calculated, we have 18 and it is an what? Outflow. So for your payables, check for your payables. Where's our payables? This is your payables. Trade payable at beginning is what? 6. At close, it is 12. It means your payable has increased by what? 6. And when your payable increase, it means you are not giving out money. So it is an inflow, 6. Are we getting it? Accruals. If you're given accruals, you check for it. If you are not given, don't bother yourself. Prepayment, we are not given. Then, what else can we have? Interest paid. I told you that your interest paid must be the same with your what? With your finance cost. Interest expense. So your interest paid is what? 28. Your tax paid, you will adjust for tax. Is that taking? Go for your tax, go and look at tax. Taxation at the beginning is what? 86. At beginning is 86. At close, what at close is 102. What is the tax paid during the period? Go and check for it. Tax paid during the period. Taxation 124. Have you seen it? Taxation is what? 124. 124. So what do you have as the taxation for the period? 86 plus 124 minus 102. That will be your tax paid. 86 plus 124 minus 102. That is having 108. 108 is a what? Is a tax paid. So you just go to tax paid and you put 104. Tax paid 108. But remember, it is workings. So the interest paid, tax paid must be deducted. So if you add everything together, just add it together, you will have your 392 plus 28. This gives you 420. This gives you 420. Then 118 plus 18. You can put that here. You can put that here. Nobody will penalize you. 118 plus 18 will give you what? 136. Bring a 136 here. Add it with the 420. You are having 556 as operating expenses before changes in working capital. Okay. Then for your changes in working capital, you have 4 plus 18 minus 6, or minus 4 minus 18, that is minus 22, plus 6. You have what? 16. Prepayment, nothing for it. So this one is having minus what? 16. So your operating activities is 556 minus 16. What do you have? You have 540. For the 540, less your what? Less your 28, less your 108. You are having 338 as your cash flow from up. Oh, sorry. We have dividend paid. There's a dividend paid as well. After interest paid, we also have dividend paid. See, dividend paid, we are 66,000. Dividend paid is like, you will treat it as that of the interest paid. So we have interest paid, tax paid, we also pay dividend. Dividend paid. Dividend paid is also an outflow because you pay it out. So your 540 minus your 66 minus your 108, you will get a net cash flow of 338. Is that taken? That is how you will get our net cash flow from operating activities. If you've gotten that, then the next thing is to move on to what is to your investing activities and financing activities. Okay, so now let's go to the solution. I believe that you now understand everything by now. So this is it. That is just what we have done. Profit before tax, depreciation charge, loss on disposal. You see, we arrive at 338, the same thing that we got there. Then we have our cash flow from investing activities. That is amount to pay for non-current asset, 90 million naira, given to you in the additional information. That is acquisition of NCA. I gave you the format in our last class. In our previous class, I gave us the format. I said for investing activities, proceeds from sales of non-current asset, acquisition of non-current asset, dividend or interest received. Okay, and for financing, yes, also under this financing, investment and interest paid can be classified under investing and can also be classified under financing. It depends on how the question comes. Why I put it under investing activities is because the dividend, this dividend paid, I can also put it under my financing activities. Is that taken? If I like, I can put it there. No issue, no cost for that. So payment to acquire NCA is 90. Sales of tangible current asset, that is proceeds from sales of non-current assets. You will check it. There's always an adjustment if there is acquisition of assets. So I've done the working note here. And how do you know that there's adjustment for it? Look at your non-current assets. Cost. You see that the current asset at the beginning and that of at close is different. At the beginning, you are having 1560, and at close, you are having 1596, which means there must have been the purchase or sales of an asset. And also, we are told that there's a loss on disposal, which means we sold an items that made us to have loss on disposal. Is that taken? You will adjust for that. How do you adjust? The opening balance at the beginning. Balance at the beginning of the assets. Then you have addition, which is the 90,000 assets that we acquired. Then the depreciation charge for the period. What is our depreciation as given in the question here? Depreciation is 118. You put the depreciation charge, you put it there. Put the depreciation charge, less depreciation, then disposal. Disposal means what we dispose. What is the net book value of the asset? We will check for the net book value of that asset, the balance as at close. Okay, when you check for the balance as at close, then it should give you a synopsis of that asset. I hope the solution is cleared. That was how we were able to arrive at the balance carried down. Is that taken? I put it there that disposal proceed is 30 minus 12 minus 18. That is the disposal. All right. The changes in the equity to that flows. I have payment to acquire non-current assets, received from sales of disposal, which is this 12 that I've already done here. Then there's nothing again. I have my net cash flow from investing activities. Then I add my cash flow from financing activities. Issue of shares. You will check your statement of financial position. Is there any issue of shares? Go to equity share. Share capital at the beginning is 340. At close is 360. Definitely, we have already issued that shares. Go to your financial, go to your operating activities. Nothing like that. But here you could see issue of share. Go to additional information. Did they tell you that share was, they didn't give us. So the one that we have here, 360 minus 340 is your issued of shares. Okay, share issue 20. That is why we are having 360. The same thing, check your share premium. Your share premium is 25 at the beginning, at close is 36. Just say 36 minus 24. Just as you say 360 minus 340. When you issue out shares, more money comes in. So it is an inflow because money flow into your companies. Okay, that is the inflow we are having here, 32, as we've done the additional information here. Okay, all the flow of the working capital, I did it. The long-term liability, I did it. Just go through it. And if you have any question, please feel free to ask. If you have any question, feel free to ask. That is that on KenCo. I hope it is clear. You can actually unmute yourself and ask questions, because we want to look at another question sharply. We have no time. You can also type your question. All right. Let's go to our question 2 of today. Our question 2 of today. Here I'll be very brief, because now you have I believe you have the understanding of the cash flow statement. We have taken our time to explain for the previous one. So by now, I believe that we have the understanding. So there won't going to be any issue for us when we are calculating it. So let's go. We have set out below are the statement of financial position of IMA company as at 31st of December 2002. Okay, we have our revenue, we have our cost of sales, we have our gross profit, we have our profit before tax. Then they also give us statement of financial position. Then we have additional equity and liabilities, followed by additional information. It is the additional information that we will actually be paying much attention to. Okay. The first one is the proceed from the sales of non-current asset investment amounted to what? 30,000, giving us a bonus. Fixtures and fittings, which original cost 85,000 and a net book value of 45, were sold for 32 during the period. Something is having a net book value of 450 and we sold it at 32. What happened? Definitely, we have incurred loss on disposal. Is that taken? I hope you are taking notes. The following information relates to PPE. Opening, closing. You can write opening, closing in your answer booklet so that you won't make a mistake. Okay, closing always comes first before opening. On 31st of December 2002, IMA purchased a chalk quarry from which extraction will take place for 5 years. At the end of that time, IMA will be obliged to close off the quarry and make the area safe. The cost of this has been estimated and discounted to a present value of 40,000 naira, which is included in the carrying amount as shown as a what? Provision. Now you are having a provision question. Okay, but chalk quarry is actually an asset, and that one will be affected under your what? Under your financing activities. All right, 50,000 naira, 50,000 $1 ordinary shares were issued during the period at a premium of 20 cents per share. 50,000 and it is 20 cents. How will you do that? You multiply. Is that taken? You have to get the value. And to get the value, you have already done group account and you know how to convert shares to what? To value. The short-term investments are highly liquid and are close to maturity. Nothing concerns us. Dividend of 80,000 naira were paid during the year. We don't hear. Okay, but this share capital issue, remember, is having a premium of 20%. So you will share it between share capital and share premium. All right, without wasting much of our time, set up your pro forma as I've done earlier, as I did earlier rather. Set out your pro forma. Let your first page be operating activities. Then your page 2 should be financing and investment. Required to prepare statement of cash flow using the format laid out in IAS 7. You can see, using the format laid out in IAS 7. IAS 7 just says you can use either direct or what? Indirect. But IAS 7 actually favors indirect format. Is that taken? So let's look at our various adjustments. My first working note here is a depreciation charge. I've told us how to set out your pro forma. Use my PDIP, IRPIT. Use it to set up your pro forma. Then you just be inserting the figures. But those things that need adjustment are what I just bring out for you. And there are depreciation charge. Depreciation as at 31st of December 2002. Depreciation as at opening, closing. For assets sold. This is it. Depreciation. Where's our opening is 305, closing is 380. What happens in between? Depreciation would have happened. Then if there's any sales or sales of assets, we see. Then we are given accumulated depreciation. Opening is 290, closing is what? 340. You can see. Opening is 290, closing is what? 340. Then we are told that there's a disposal of assets. Fixtures and fitting, which original cost 85,000 and a net book value of what? It's 45. What happens therein? Definitely there's a what? A disposal on that. I mean, there's a depreciation on that asset. 85 minus 45. What happens is what? Depreciation. Original cost is 85 and net book value is 45. Definitely there's a depreciation of what? 40. So that was how I got my 85 minus 45, which is what? 40. Is that taken? So if you add it together, my 340 minus 250, I'm having my what? 90. This is what I'm recognizing as depreciation for the year. And if you want to solve it in a straight line method, you will just have your what? Your 340. If you want to solve it using straight line method, you just have your 340 minus your 290, then you plus your 40. You have your 340. This is closing minus opening plus the depreciation for the year. Is that taken? And that will give you the same 90. Is that taken? That's how to get your depreciation for the year. Having gotten your depreciation charge, you just put it here. Profit before tax, 300. Adjustment for depreciation, 90. Profit before tax, 300. That's what I use. Depreciation, we've calculated it now. The depreciation that we calculated now, 90. That's what I brought here. Loss on sales of assets. We were told, while reading the additional information, I told us that an asset that is having a net book value of 45 was sold for 32. Yes, that is a loss now. So you will account for it. Loss on sales of assets, 45 minus 32, 13. Then profit on sales of non-current assets. Non-current assets. Profit on sales of non-current assets. Just a sales of non-current investment. The proceeds of the sales of non-current investment amounted to what? 30 million. Can I see that? Amounted to 30,000. That's 30,000. Then go back to look for the non-current investment. Investment. Can I see investment at the beginning is what? 25. How much do we sell it? We sold it at 30,000, which means there's a what? There's a profit. Is that not? Profit of what? 5 naira. Just say profit on sales of assets. This is 30 minus 25. Is that taken? Likewise, your interest expense. Your interest expense. Check your question. Other income, interest received. You can see interest received. So you're having your 50, then adjustment for non-cash items. You have your inventory. You know how to calculate for your inventory. Inventory at opening. Here's my inventory calculation. Inventory at opening minus inventory at close. You're having 48. Receivable at opening minus receivable at close, I have 75. Payables at opening minus payable at close, I have 8. Do we get that? So that is how I arrive at my inventory, receivables, and payables. Then my interest paid with tax paid. Then my tax paid adjusted, dividend paid, don't forget. So you have my net cash flow from operating activities. From there, go to cash flow from investing activities. Cash flow from investing activities. Payment for acquisition of non-cash item. Acquisition of non-cash items, non-current assets rather. Acquisition of non-current assets, I've already done it here. That is 161. Then intangible assets for non-current assets, 50. Then sales from proceeds of an asset that I sold an asset for 32,000. That's 32,000. Sales of non-current asset investment. The non-current asset investment that I sold for 30,000. This is it. Interest received. on my investment. Interest received 25. That's that there. My finance cost is your interest paid, though I told you earlier. And I said, you can see 75. That's your finance cost, too. Don't make the mistake. You see that it's your interest paid. It's quite different from interest received. Interest received is investing in the company that you put your money. What you are receiving from there is interest. If somebody puts money in your own business, what you'll be paying that person is also what? Interest. That is the interest paid. The interest you are receiving from where you put your own money is interest received. And it's a part of your what? Investing activities, because you invested in it. Why are we having sales and acquisition of non-current assets under investing? It's because your business, you invested on it. All those things that you are buying, that will aid, that will support your business, is called investing activities. Let's assume in your office, if you buy system now, if you buy system to actually, if you buy system, that system would really help your business. That is investing activities. If you deal with pure water, if you are in a pure water business and you buy motor van to be carrying your items, to be carrying your goods, that motor van that you bought is your what? Investing activities. I hope that is clear. Then your financing activities are those people that put money in your business. Those people are your financing activities, such as what? Issues of shares, such as long-term loan. And at the end of the day, you will be having your net cash flow from, you have your net cash flow from financing activities. If you add everything, you will add cash and cash equivalent at the beginning. If you add your cash and cash equivalent at the beginning, that one we already been given in the question. Go to your financial position. Under your assets, you see cash in hand. This is cash and cash equivalent at the beginning. Okay, that is your cash and cash equivalent at the beginning. If you add it to what you are getting, you must have cash and cash equivalent at close. So your cash and cash equivalent at close. That's why I have cash and cash as at 1/1/2002 is 97. There's adjustment here because the cash in hand is 1, and we also have bank overdraft. The bank overdraft is 98. As at the beginning, bank overdraft is 98 and cash is 1 naira. If you remove 98 minus 1, you are having what? 97. So your cash and cash equivalent is 97 at opening. At close, bank overdraft is 85 minus the cash you were given at close. Cash in hand is 2 naira. If you less 2 naira, you are having what? 83. So just check. Cash and cash equivalent at opening is 97. 64 minus 97, you are having what? 33. Which means we would have already adjusted for our cash and cash equivalent. So to adjust for our cash and cash equivalent, go back to your, we have bank overdraft at opening is 98. at close is what? 85, which means there's what? 98 minus 85. You are having 13. It has reduced, right? That is, there's more cash outflow. You are having 13. So 1 naira minus 2 naira. 2 naira minus 1 naira, you are having what? 1 naira. Then the following relates to the information of plant and machinery at the beginning of the year. The short-term investments are highly liquid and close to maturity. So that is how to actually solve for that. Yes. -64 minus 97. So this is my cash and cash equivalent at close, which is 33 naira. So at the end of the day, your cash flow must balance with what you are having. I hope that is cleared. Any question before we proceed to another questions, which will be our last question on statement of cash flows. You can actually unmute yourself and ask question. You can unmute yourself and ask question. Hello? All right. How do we determine the interest payable on account? How do we determine the interest paid in cash flow statement? Anybody? Hello?
Software was you. Kindly provide answer to the question. Infinix. You can either put it in the chat or you can unmute yourself and answer. Just give it a try, don't be shy. You can send it to the host if you don't want anybody to know. You can send a message directly to the host. Can you guys hear us? Can you confirm you can hear us? Karen Topper was you. Infinix. IK. Kindly confirm you can hear us by unmuting and saying yes, we can hear you. Or sending a message to the chat. Okay, Infinix says, I can hear you, sir. Very good. Karen Topper was you. IK. Kindly confirm you can hear us.
If you can hear us, it means you have to solve this next question by yourself.
She also says I can hear you. Topper says I can hear you. So you guys, okay, so your tutor is going to give you a question to answer now. So kindly participate, please. Your participation is very important. Don't be scared. You understand?
This is the most simplest question that I'm giving to you as a classwork. Okay, but I won't leave it for you to solve. The following information relates to Geofrost, a limited liability company for the year ended 2007. Oh yeah, you can unmute yourself. We are given the statement of profit or loss, and we are given the statement of financial position. Also, you are given equity and liabilities and additional information. Depreciation expense for the year was 4,658,000 naira. How will you treat that depreciation? How would you treat that depreciation? You can unmute yourself and talk to me. Unmute yourself and talk to me. How would you treat that depreciation? Hello? Okay. You will practice that and send it to me because of time, since you don't want to talk. If you can hear me, talk before I turn it to assignment. Should I give it to you as assignment? The solution is not in the slide though. Should I give it to you as assignment? You can type yes if you can hear me. If you want it as assignment, say yes. If you want it as classwork, say no. But I'm not solving it alone.
Karen says no. That means she wants it as a classwork.
Okay, very good of you. I like that.
Infinity says yes. That means he wants it as an assignment. Okay. So let's see. The other people should go so that we know.
Okay, I can hear somebody saying no.
I want us to treat it now.
You want us to treat it now? Thank you for that. But this is the condition. If I treat this one for you now, a district will be shared to us, and you must attempt it before the close of, before today runs out, before 7 p.m. Can I get it? If I treat this one for you, it makes 4 different things that we've done under IAS 7 statement of cash flow. I will give you assignment to do. One will be very, very simple. Another one will be tough. Yes, we have to go through this. All the questions that is being given to you in your slides are examinable questions. And that is why ICANN Online are there for you. One thing that you just need is go through the slides once again, relax by reading the questions. There are some things that we notice. Ask questions. That's why we are there for you. Is that taking? Okay. This question is the most simplest one, and let's quickly do it. And the one that I will send to you too, I will send it and our admin will forward it to the group for you. It is the question alone that will be forwarded to you, whereas I want you to attempt it and submit before 7 p.m. I will grade you. Take note. The following information relates to the person, and the statement of financial position has already been given. Finance cost, they even bring that one out for you. Investment income, profit before tax, less or tax, P or L, profit for the year. But I said always look for your word, profit before tax. Statement of financial position, we are also given. Opening, always come last. Closing, always come first. Write that on your book. Nobody will penalize you. Then go to your equities and liabilities. Check your ordinary shares. Is there any movement? Opening and closing, there's difference. Retained earnings, opening, closing, there's difference. Loan, opening, closing, there's difference. Sorry, let me start from here. Non-current asset, opening, closing is different. Current asset, inventory, opening, closing is different. Opening, closing, there's difference, there's difference, there's difference. But what will not touch is your cash and your what? Overdraft. Okay? Oh, we still have bank overdraft here too. Loan is different. Bank overdraft is different. Payables is different. Taxation is different. But for this taxation, you will always check whether your profit or loss also have taxation. You see less tax, then you are fine. The clue there is when you are working with operating activities, you stick to P&L and your what? Assets. That's just it. Since you understand, additional information is that depreciation expense for the year is 4658,000. Check your depreciation. Is it the same thing with, oh, we are not given depreciation here, but they now tell us that the depreciation for the year is 4658. So if you check your non-current asset, the differences that occur here should have been depreciation. If there's no further information that there is acquisition of asset or disposal of asset or selling of an asset or loss on asset. If there's nothing like that, then what has occurred is depreciation. Compare it with the depreciation you are given for the year and adjust. Assets with carrying value of 1974, good. We are disposed at a profit of 720. They tell us that assets that have a net book value, that's what we call carrying value. We are disposed at a profit of 720,000 naira. Is that taken? Then prepare statement of cash flow for the year ended. Mostly prepare statement of cash flow. They didn't tell you use direct, use indirect. I don't want to just determine that. And let me tell you that the one that can earn you more mark is indirect. The one that can lessen your tax is indirect. Though you now know how to prepare direct one too, I agreed that you know how to prepare direct. Just go through the formula that I gave to you and you prepare the direct straight without itches. Since you know how to prepare the direct, but I would advise to always stick to indirect. Know the direct one, no, so that you won't say I'm the one that said you should do this. But know the direct and know indirect. Indirect, just use your formula. See that you use P dip diff, IRP, IT, or you call it PIF dip, IRP, IT, anyone you like out of the two. This thing can be easily got. While I didn't use it to form a direct or what can I call it? A direct, this thing that we can easily pronounce is because I want those items to follow suit, just as they've been, such as the IAS7 has stated it in the format. I don't want anything to be different, and I don't want to introduce what is not there. That's why I've come about this PIF dip IRP IT. Thank you. Like you know, adjust for your tax, adjust for your PPE that is having carrying amount. And it's not necessary that you do it in T format. I keep telling you, you can do it on a straight line. How do you do it on a straight line? Opening balance is 4090 for tax. Less your closing balance. Let's check this thing. Where is that tax? This is taxation. Opening is 2760. Closing is 3020. Opening is 2760. Less or closing 3020. Then you will add the tax for the year. There's no tax here. Where did they say less tax? Less tax 4350. Then you will add that. Less tax 4350. What you will get is tax paid. So simple. Just press your 2760 plus 4350 minus 3020. Then you'll be having 4090. This is the one you are using. Is that picking? You can do your PPE too like that. Check for your opening PPE. This is your PPE, non-current asset. Opening is 26,549. Closing is 43,282. Just say opening. Opening is 26,574 minus closing, which is 43,282. Because opening will reduce to the closing because of the depreciation. So you will less depreciation too. And what is the depreciation that we are given for the year? Depreciation charge for the year. Depreciation charge for the year is 4658. So you just less 4658. They say there's disposal. When you dispose an asset, your asset will reduce. So you will less disposal. Disposal is 1974. So minus 1974. That is what you want to get. And this will give you if there's any addition over the period or not. So punch your calculator. 26574 minus 43282 minus 4658 minus 1974. Then there's a this thing of what do we call it? 233340. That's just it. Okay, so you have 23340. This is the 23,340 is the addition of PPE. PPE acquired during the year. That's just what it means. That is what we are getting it for. You've already gotten the closing PPE. The closing balance has already been recognized in the statement of financial position. But what you just want to check is there any additional? And to get whether there's addition or there's a loss or there's a disposal, if there's addition, closing will be higher than opening. Definitely there's addition. And you also check whether there's a disposal if such occur. But the question will tell you if there's a disposal, there's a disposal loss. Simple as that. Don't bother yourself unnecessarily. Here's the solution. Cash flow from operating activities. Profit before tax, 15,000, as we are already given. Nothing required. Profit before tax, 15,000. Then add your non-cash items. Finance costs, you remember, 400. You still remember, I said this one, they've even given you directly. Or what is added from this profit after tax? What is add? You will less. What is less? You will add. It's like working back. Okay, investment income. I said what they add, you less. What the less we add. Then depreciation for the year. First is 58. We are just for the depreciation. We are not given depreciation here, Abby, but we are given for the depreciation for the year. 4658. That is what we are using. 4658. Then they say there's profit on disposal of PPE of 720. Then check your inventory. What happened? Is it increase or decrease? All this thing is possible when you open your book. I said open everything. That's what I said. Open it down. When you open it down, just be inserting, just be putting it. Please follow the rules given to you. Open it down. You remember what took our time when we started. This one is the one that took our time when we started. Kinko, you see that I opened everything down and it's still balanced with my solution. If you open everything down, you don't have issue. Please open everything down. Open it down. Okay? All right. So just do so immediately after you check your inventory to see whether there's a distance there or not, then you are fine. So just like the first one, you are fine with it. So money there. Put this up here. Put up another one. Again. All right. So that is just all you needed. Just identify whether there's an increment or decrease in what you are doing. Then the rest is simple for you. Okay? The rest is simple for you. If there's increase, you already know how to do. You already have understanding of increase in inventory, increase in receivables, or decrease in payables, and the rest. You don't have to put decrease, increase, increase. Just write inventory. You are the one that know whether it's increase or decrease. If it decrease, if it is decrease, it is inflow. Increase, it is an outflow. At the end of the day, you get a cash generated from operation. Interest paid, which is the same thing as a finance cost. They will call this one finance cost or interest expense. It's the same thing. Interest expense or finance cost. Then your tax paid. I think we adjusted for tax paid here where we get 4090. This is it. Then you get your net cash flow from operating activities. From investing, we did this thing 2 years where we got addition of PPE as 23,340. That is your purchase of PPE or purchase of non-current assets. Then proceed from sales of non-current asset. They said an asset with a carrying amount of assets with carrying value of 1974 were disposed at a profit of 720. It's having 1974. Then we dispose it at a profit of 720. That's what it means. We sell it at this amount and we still see a profit of 720. So you add it together, disposal. This is sales of current assets. 1974 plus 720, the carrying value plus the profit we see on it. Then we have dividend received in the questions. This is it. Retained earnings that increases. Remember that profit is paid out of retained earnings. Is that not? So what makes your retained earnings to increases is as a result of what? Dividend. Do we get that? That is the dividend received. Then you have your net cash flow from investing activities. This minus this plus this plus this is giving you that. So the next one is financing activities. I told us issue of share, that shares increases. Where share increases, it means you've issued out shares. That's what makes it increases. From 17 to 19, that is what makes it increases. Okay. Then look at your debt as well. What you'll be finding, just as you just as you understand inventory is also the same thing. This minus this. But when you issue that shares, it is an inflow because people are coming to buy your shares. So it is an inflow. Loan from 10,000 to what? 8,000. From 10,300 to 8,000. So there's a what? Decrease of 2,300. Non-current liabilities is a loan you collected, not the one you give to people, it's the one you collected. So when your loan decreases, it means you pay out part of your loan that you are owing. This is the 2,300 outflow. Then what makes your dividends to reduce is the dividend you paid. To increase this rather is the dividend you paid. Is that taken? And remember, here you are having a finance cost, which is those people that you bought, that invested in your company. And that is finance. Those people that invested in your company, you are using their money to finance your business. That is what finance means. Invest means those people you put money in their company, you invested in their company. Is that taken? So adjust for the dividend. Then everything you get is net cash flow for financing activities. After that, you adjust for your cash and cash equivalent at the beginning of the period. At the beginning of the period, you have what is your bank overdraft at the beginning of the period. Bank overdraft is 429. Cash is what? Cash is 1063. Okay. That's why I have 1063 minus 429. Is that taken? Cash and cash equivalent at close. Bank overdraft at close is 7562. Then cash at close is 2045. So if it is 2045 against against 1230. So it means you're having more cash than overdraft. So 2045 minus 1230, you have 815. And your cash and cash equivalent plus your opening must total what you'll be having as this plus this is 815, which means if you adjust for your cash and your overdraft, this your overdraft minus this cash minus your cash must also be able to give you the same thing that you will get. But if there's no overdraft, you will just use this cash at opening, add it to your cash and add it to your net cash flow for the period. If you add this one to your net cash flow for the period, what you will get is cash and cash equivalent at close, which will be equals to this. But because of the overdraft, we adjust and we are having what? This. That is that on cash flow statement. Any question, please? Is it cleared? If you get it, kindly type yes. Is it cleared? You can unmute yourself because we are going to another topic, which is profit or loss and mid-year acquisition. profit or loss account, and mid-year acquisition. Do we understand cash flow statement very well now? Any question before we go to that? Any question, you can unmute yourself and ask question. We have actually come to the end of IAS 7 cash flow statement. And our next topic shall be statement of profit or loss, consolidated profit or loss and mid-year acquisition, before we now go to publish account. If there's no questions, I implore you to practice more questions on that. Check past question, but I'll also be giving you a question for you to solve for me today in order to know if you truly understand what we have discussed so far or not. All right. Let's go to the next one because of time. You have a lot to do. By next week, we should be examining published financial statements. That's what we'll be doing by next week. Publish financial statement and possibly ratio analysis. Okay, prepare. We have checked a question on consolidated profit or loss. When we look at one investment, one associate, I think we still remember when we are looking at Davido and Co. So, but there's a need for us to actually look at more basic consolidation procedure. For consolidated statement of profit or loss and other comprehensive income, it's just a normal statement of profit or loss and other comprehensive income of the parent company and its subsidiary that is prepared and presented as if it is a single entity. But what you have to take note under it is that the income to be shown or included in the consolidated statement of profit or loss and other comprehensive income must be the income earned from non-group member or from third party only. You must not include the income of subsidiary in that consolidated statement of profit or loss and other comprehensive income, SOCI. Is that taken? This means that the income earned from group member should not be included. This means that the income earned from non-group member or third parties, this means that the income earned from group member should not be included in the consolidated statement. And as a result, any income earned from group member must be identified or determined and subtracted from the income item where it has been included. You know the various adjustments that is attached to profit and loss account. So you adjust. Also, expenses to be shown or incurred in the consolidated statement must be the expenses incurred to third parties or non-group members. Any expenses incurred to a group member must be identified and subtracted from the expenses items where it has been what? Included. Another note is cost of investment in subsidiaries. Information relating to cost of investments in subsidiary must be totally ignored. Ignore it when you are preparing consolidated SOCI, except if goodwill calculation is required. If they did not ask you to prepare goodwill, please ignore cost of investment, which is that consideration transferred. Ignore it. But if they ask you to prepare goodwill, you know now, obviously, if you are preparing goodwill, you have to show consideration transferred, add NCI value, add DOA. That is only when you can use cost of investment. For share capital and reserves of subsidiary at date of acquisition, share capital and reserve, including the retained earning of subsidiary at DOA, should be ignored totally. Ignore it when you are preparing consolidated SOCI, except if goodwill calculation is required or we are required to prepare consolidated statement of changes in equity. All these things we are going to prepare and still examined under our published financial statements. Other relevant adjustments were intercompany sales, where there's intra-group sales. You know how to deal with that already. We discussed it in all our previous classes. So please go back to check. Intra-group sales or intra-company sales is that the sales value of the intra-group sales should be subtracted from the sales revenue and also subtracted from the cost of sales. You know that already. Then if there's any intercompany interest, the amount of the intercompany interest will be subtracted from the finance cost and also be subtracted from the what? Investment income. Let's go to the question because of time. No story. Yes, that is just a clue for you to know what you are looking for. Then the next thing, you go to a question to solve it and demonstrate all what you have been saying. And after that, we are going to examine more questions on them. Yes, mid-year acquisition. Sorry, I forgot to tell us that. Where mid-year acquisition, where there's acquisition at the mid-year, only what you need to do is look out for the date for that mid-year. If you look out for the date, then you prorate. How do you prorate? You will prorate. Proration is you divide the month by the numbers of the years. That is the proration. Okay. That is the numbers of months from date of acquisition to date of consolidation will be subtracted from what? 12 months or equals to months, but can never be more than the what? 12 months. Look at the question. Oh, first, before the question. This thing might disappear again. Let's assume if you are having, we call it mid-year acquisition. Mid-year acquisition. Don't worry. All these things, I have enough question for you on them. It's true that you should be ready to accept them or to collect it. For the mid-year acquisition, I said the numbers of months from DOA to what? DOC. For instance, if it is acquired in July and the company prepares its accounts to December, you just count from 1st of July, July, August, September, October, November, December. That is 6/12. Then you multiply it by the what? Cost of acquisition. But during the consolidation, where there's acquisition during the year, all you need to do is to calculate the subsidiaries retained earning at DOE, if not given. Okay, I said doing consolidation. Doing consolidation where there is acquisition during the year. All we need to do is to calculate subsidiaries retained earnings. Calculate subsidiary retained earning at DOE, if not given. Okay, if you are not given, calculate subsidiary net assets at DOE, if you are not given. So, and you know how to calculate subsidiaries net assets at DOE. It will be subsidiaries retained earnings brought forward. Okay, let me quickly do that. Calculation of subsidiaries retained earnings at DOE. Okay, you have subsidiaries retained earnings brought forward. Then add current year profit relating to the numbers of months, relating to number of months. Okay, that is relating to the numbers of months before acquisition. So if you calculate it, you will get DOE retained earning of subsidiary. You get subsidiaries retained earnings at DOE. That is just the idea. Okay. But where there is intra-company loan, the current year profit above should be the current year profit before intergroup interest. All these things, we will examine it with your questions. Okay, I just need to introduce you to the topic and solve a question on it, because no be play again. Yeah, given the following financial statement as at the year ended 31st of December 2005, Veda and Maru, the great players, we are given the revenues up to the profits for the years, and we are given the additional information, which includes on 1st of July 2005, Veda acquired 80% of the equity shares of Maru, and it is the group policy to measure the NCI at acquisition at fair value. Maru declared a dividend during the year of $10,000. An impairment review at the reporting day revealed that goodwill in Maru to be impaired by $20,000, assuming that the profits are accrued evenly. How will you prepare the consolidated statement of profit and loss for Veda Group for the year ended 31st of December? First, determine the acquisition date. When was subsidiary company acquired? 1st of July. From 1st of July to December 2015, that we are calculating, that we are consolidating, how many months? Just count. July, August, September, October, November, December. That is 6 months. July to December equals to what? 6 months. Okay, so anything you are doing, it will be what? 6/12. Let's go. So just your normal consolidation. Revenue, the parent, 1645 plus 1280 multiplied by 6/12. All this one times 6/12. Okay, because it is acquired mid-year. Revenue 1645 plus 6/12 times this. The same thing, cost of sales Then you have your gross profit. Your distribution cost, the same thing, parent, subsidiary. Subsidiary will be multiplied by 6/12. Admin cost, remember that we were told that there's impairment of 20 million, Abi. Goodwill was impaired by 20,000. You will impair the goodwill by 20,000. Okay. So you will impair the goodwill by 20,000, and that is 60 plus 6/12 times 50. Impairment must be added to, remember, because it's supposed to be added to the retained earnings of the what? Subsidiaries, and less from what? I mean, retained earnings of the parent, and deducted from the NCI value. Note that. Profit before interest and tax is what you have after adding this. Then you are not changing anything. Just follow this rule. What they've given to you, just follow it. Revenue, cost of sales, gross profit, administrative, finance cost, investment, profit before tax, profit. You will just be adding and deducting all this additional information. That's just what you want to do. Okay? But you have to understand what you are doing. You need to understand what you are doing. Okay? You need to understand what you are doing. If you do not understand, then there is error. You need to understand it. Understanding it is actually the basis. Okay? So let's go. So your finance cost the same thing, your investment cost the same thing, your profit before tax, this, just be following that trend given to you there. Then profit before tax, your taxation will also be divided by 12. Then after getting your profit for the year, that profit for the year, you will now share it. You first of all remove non-controlling interest, and the balance will go to the parent. Non-controlling interest, what is the percentage of acquisition? 80%. So which means if you've drawn your group structure, it means NCI will be what? 20. Is that taken? So 20% of NCI, 20% multiplied by, what is the NCI value? Profit for the year for the NCI is what? 112. That's what you are using for NCI. Profit for the year is 112. So multiply by 112 times 6/12. Then you have impairment goodwill of 20. You will list it here too. So find 20% of this minus 20, you are having 7.2. This 7.2 minus 198. So everything give you 190.8. So that is how to do the share of profit that is attributable to both of them. That is that, my professional colleagues, for the parent and subsidiary of mid-year acquisition. Okay, we have come to the end of today's class. Ask your question where necessary. Thank you for your time and being attentive for the class. I need you to ask questions for me to know that you actually understand all what we discussed. In our next class, we shall continue with mid-year acquisition and publish financial statement. I've just solved one more question for you for mid-year acquisition or two, then we go to publish financial statement. After that, our should I call it last or second to the last that we should be examining when it comes to group financial statement is ratio analysis. And after that, go and attempt any question. I can bet with you that we trust that question as if the question has passed its boundary. I wish you sound knowledge, good understanding, retentive memory, and best of luck in your examination. While I'm waiting for your question, thank you for your time.
Okay, hope you guys enjoyed today's class. So let's have your questions. Have they been given an assignment?
I will send it to you.
Okay, the assignment will be sent to the WhatsApp group.
Okay, I'm there. I'm there. I will send it there.
Yeah. So it will be sent there for you to attend. So our exams are approaching for ASPA day by day. This is not the time to hide from the reality. For the first time, ICANN is having the exams, if I'm not wrong. At least I know of first week of May,
Yes.
which is 4th to 6th. My prayer, though, is that they will extend or postpone the exam, but I'm sorry, we can't work with that at the moment. So prepare your mind for 4th to 6th. I'm sure they have a good reason for putting it to 4th to 6th this time around. So prepare your mind for 4th to 6th of May. So this is the time to brace up. You have just about 40 days. That's less than 6 weeks. So ICANN is not a joke. I must tell you. In as much I'm encouraging you to brace up for the exam, to have confidence. Preparation is key to passing the exams. And I'm sure I've shared some tips with you guys on how to prepare for the exams. So don't say you don't have time. I work Monday to Friday, traffic. This is why we provided the solution for those people that are busy. So when you are inside the bus or you're inside your car, make sure you're playing videos. Any free 5 minutes you have like this, make sure you are using it to study. That 1 hour break you take at work, utilize it fast so that you can utilize it. So that when others are going out for lunch, you are busy with your book. Or even if you are going to be having lunch, because actually you need food to be able to read and assimilate. You need a lot of food. Don't eat too much also, because eating too much will make you feel sleepy. But you still need food. But while others are going for lunch, you can just buy snacks and take snacks and water. Take a lot of water, very important. Sleep at night. You need a very good sleep to have a sharp brain to be able to study during the day. Get a small jotter, like a 2A note that you can put in your back pocket and take anywhere, and make sure you jot bullet points. Just make it bullet points, key points. Just know the key points, the salient points as you are reading. So is that booklet, you can't be carrying your study pack everywhere you are going. But that small booklet that you have summarized your notes, just put it in your back pocket or in your bag. Anywhere you are, open it. Don't be shy. You are in the toilet, open it. You are in the bus, open it. Any free opportunity you have, utilize it. And once you are prepared and you have your confidence to go into the exam hall, then leave the rest to God. You've done your own part by preparing, coming for these classes, watching the videos, going through the slides, attempting questions in the Pathfinder. Don't be discouraged if you attempt a question and it doesn't balance or you didn't get everything right. I can tell you categorically that most of the people that become chartered accountants today, most of them did not have their account balance in the exam hall. And that didn't mean that they failed that exam. It's not until you balance the account you will get the mark you need to pass the exam. Yes, I encourage you to strive to make sure your account is balanced. But don't be discouraged when you are practicing and your account is not balanced. There are other things that the examiner is going to mark there. In fact, if you are too worried about your account being balanced, you don't find out that you look marks in other areas that you're supposed to earn marks. So I wish you guys best of luck in your exams. Your classes will continue next week. Before you go for your exams, we also have at least one question and answer session with you. And possibly, we're also considering you having a mock exam to see your level of preparation. And I want to encourage you to participate in that mock exam. So Karen is raising up and okay, Karen, you can unmute and ask your question.
Okay, sir. Please, I just wanted to ask, the calculation for investment income is different from all the others, so I wanted to understand it more.
What did you say?
The calculation for investment income.
Yes.
You said it's different from others.
Yes.
Yes. If you look at the investment income that we said the investment income is actually what the person is receiving from his investment. And investment income is the percentage of the holdings, the interest we are getting from that holdings. First of all, go to the slide. You see that investment income is what? 10 naira. The parent company only have the investment income. Maui is not having. That means it is the investment that Veda is having in Mau. Is that clear? It's Mau that is paying in what? Investment income. That is why that investment income, you're only calculating 80% of it, which is the one that belongs to the parent. Okay.
Okay, sir.
That is why we have. You understand it now?
Yes, sir.
That's just it. It's like a parent and subsidiary. Remember, we are still under consolidation. And whatever the parent is doing to the subsidiary is still within. It has to be removed. Let me remove the 80% acquisition that I have in that. Then maybe the other investment has come from an outsider. That is just what that one means.
Okay, sir. Thank you, sir. Yes,
You're
sir.
welcome. Please try to go through them once again.
Okay, sir, I'll do that.
All right. We have come to another end of another corporate reporting class, group accounts. So we hope you enjoyed the class. If you have any questions after this, you can drop it in the WhatsApp group. Your tutor will be happy to attend to them. If he's unable to attend to them immediately, in the next class, will be attended to. Thank you, everyone, and do have a lovely day.